Hey there, Kyle here again, and we are going to continue digging into where we left off in the last video. So we've unpacked the problem. We've got multiple tax challenges here when you're a successful incorporated business owner here in Canada. Anywhere in Canada, this is happening if you're successful, which means you have profits and you're trying to get those profits out to you personally at some point now or in the future. So we've unpacked what people are typically doing now, which is doing investments inside of the corporation. Of course, there are some people who are just ripping the Band-Aid off. And what we're trying to do is find a way that we can actually have our cake and eat it too. So rather than just piling as much retained earnings into investments that are capital gain bearing or appreciating, as we would call it, because again, it still just kicks the can on the taxes to be paid on those retained earnings. What we're actually going to do is we're actually going to create a pass-through structure. Now, what's really important to note is that you already have a pass-through structure that's in existence, and you typically use it each and every day when you're in business. And that money is likely sitting in some sort of checking or savings account, which I would argue is a pass-through structure, right? You typically aren't going to keep that money there forever. That's not the end goal for it. It's just a place to put it for now. Well, what we're going to do is something very similar, except we're going to add another pass-through structure that's going to actually not only act as a pass-through structure, but it's going to have other qualities that are going to help us to deal with the tax challenges that you're experiencing. Now, we're going to unpack them here, and we're going to slowly unpack them, and then we're going to zoom out and talk about why this particular pass-through structure. So let's dig in here. So over here, let's pretend we have $1 million of retained earnings. Now, I do want to mention here, I'm going to give one example today. And of course, that means it's not going to be exactly your example or your situation, right? So keep this in mind that we can do this in many different ways as long as there's some retained earnings, or if each and every year you've been taking out a significant amount in dividends or salary, this is going to work for you as well. I'm going to use the assumption here, just to keep the numbers simple, that we have $1 million of retained earnings every single year. Now, again, this can work if you have 50,000 of retained earnings every single year, or 300,000 in retained earnings, or 10 million in retained earnings every single year. And there's some variation depending on how much you're taking out, for example. So if you were taking out, say, 300,000 in salary or dividends every year, plus you had 100,000 of retained earnings, this could be a really helpful structure for you to limit or reduce the amount of personal taxes you might be paying now or today. So we're going to start with this one example, but you can actually, extrapolate from this example to your particular situation. And of course, so let's look at this now. We're going to assume $1 million of retained earnings each year. And we're going to assume here, we don't have to take the whole $1 million to pass it through here either. We're going to do that as the example, but there's all kinds of different variations that can be done. So I'm going to assume, though, that we're taking this $1 million and we're actually going to put it into our pass-through structure that we're going to create over here. And I'm going to make a little box to represent this pass-through structure. Now, we're going to put that $1 million in there. So we've taken it from one pass-through structure, checking our savings account. We've put it into another. The one thing about this particular pass-through structure is that there's a lot of unique qualities that it has that it's going to help us with in dealing with these tax challenges. And there's going to be some bonus incentives as well. The first thing is that the first bonus incentive, not our focus here, but it is going to be helpful later, and you'll see why, is that when we put it into this bucket is going to every year be a place that we're going to keep dumping our retained earnings into. And every year that we do this over time, on average, you're going to get growth like a GIC. So that's like a GIC. It is not a GIC, this bucket. It's going to be growth like a GIC, so 4% to potentially 5% per year. And it's going to be tax-free, which is quite fantastic right in and of itself. So for those of you out there that may have a lot of retained earnings going into GICs every year or other interest-bearing assets, keep in mind that you're paying 50% of the return in passive income taxes. So by simply taking it from GICs and putting it into this bucket. Even though we're going to talk about all the other benefits that this bucket's going to have, you're going to be well ahead, and you potentially can really explode your net worth when comparing to, say, a GIC over the next 5, 10, 20 years, however long the runway might be. So again, this is a bonus. What we then do is we actually utilize this capital in order to do whatever it was that we were going to do anyway. All right. So in this case, if you were the person that was putting it into investments, we'll still do the same thing. We'll take that money and we're going to put it into investments. Okay. Now I'm speaking in general terms here. So we have $1 million going in and we have $1 million going into this investment over here. The one nuance that I want to share with you is that this is not actually taking the money out. We're going to leave this money in here. It's going to grow and tax-free at that 4-ish to 5-ish% rate over the lifetime of this particular structure. And we're actually going to borrow against that bucket in order to make this investment. So of course, there is something negative that happens here. We have interest, and we're going to talk about the interest afterwards and how we deal with that. Because really what we've done now is we've taken money through, we're going to grow it, and then we're going to grow it in another spot. We have money working in two places at the same time. There is a small cost to that, and we'll talk about that in a future video, how we're going to deal with that. But that's not all we're doing here. We're not just looking to have our money working in two places at once. That's actually really helpful. It's going to be a bonus. It's going to be helpful over the long term to your net worth, but we still haven't addressed, like, how's it going to deal with our tax issues that we've been talking about? Well, there's an awesome quality that this particular bucket has that really no other type of bucket has. And what it is it's called a death benefit. And that death benefit comes with only one type of financial asset, and that is insurance. But we're not talking about term insurance that you were renting or anything like that when, you were younger and you wanted to make sure you were just protecting your family just in case. This is going to be a permanent policy that will pay out down the road. It's not if it'll pay out, it's when will it pay out, because you will eventually die. Unfortunately, if no one ever told you that, I'm sorry that I have to be the bearer of that news. Unless Elon Musk comes up with something, special for us in our lifetime, that will happen. And this death benefit will pay out. And on $1 million policy, while different ages and different health considerations can factor into this, recently when I ran a $1 million policy on a individual who was about 50 years old, we were talking north of $10 million. So I'm just going to put 10 million to keep it simple. And that's the number we're going to use for our example. Of course, every individual is different, and we would want to run a scenario for you. Now, some people might be wondering, well, why do I want this feature? And actually, this is going to be one of the big reasons why this structure is going to be so powerful inside of your corporate structure, be it inside of just an operating company or in a holding company or within multiple companies. Wherever this is happening, we will help you with where it should go. But what this is going to do down the road, when you pass away or when the insured person, the key person in your company, passes away, what's going to happen is this money is going to pay out to your company tax-free. So $10 million will pay out tax-free, and your capital dividend credit or your capital dividend account will receive a credit of essentially the net death benefit. Now, how to explain what I mean by that? If we looked at year one and we were to put in $1 million into this policy and the death benefit was $10 million and you were to pass away later that week, for example, you'd get out about $9 million tax-free to the next shareholders. And that is going to be a really important part of this structure, but not the main focus, because this is not, we're not doing this for just everyone else. What we're going to do is we're actually setting ourselves up to be able to grow our net worth and to give us the optionality to do so much more with the retained earnings in our corporate structure to not only help our estate planning, that's going to be a nice byproduct, but we're going to talk about different ways that we can actually grow this money and be able to have tax-free cash flow at a personal level. So with this, what we have is the idea that if money is trapped in our corporation, a lot of people are either ripping the Band-Aid off and paying a lot of tax to do it, or they're putting it directly into assets. What I'm telling you now is that especially if those assets were interest-bearing assets, here you've got a bucket that's going to grow tax-free like a GIC. So for our conservative friends, that might be where that money sits for a while, and you don't necessarily need to put it into any other assets. For those who are wanting to invest it in other things, if it's index ETFs, if it's into real estate, private placements, whatever it is that you want to invest in, we're going to then leverage against this bucket in order to make those investments. So now we have money working in two places at once, and we have interest here that is going to have to be paid on the borrowed amount. But if it's going into investments, you will have interest as an expense that can be written off against some of that income, which is a fantastic bonus. But the part that you're going to be most interested in is that when policy sizes are large enough, I would argue if the policy is at least $300,000 per year of premium, then you actually open the door to use personal leverage strategies. So what we're talking about here is actually building up an asset on your balance sheet inside your corporate structure and then going to a third-party lender and talking to the lender to say, I would like to borrow money at a personal level against my personal assets, and one of which is this asset right here. Okay, now this is a corporate owned asset. However, you own the shares of this structure. So what we'll be talking about in later videos is exactly how this will work. But ultimately, the goal would be that I can actually leverage out up to 100% of the premium going in at a personal level. And we'll tell you how you can do this in a compliant manner while also growing your net worth at the same time, instead of seeing your net worth dwindle each year as you pull money out. So imagine a world where if you were pulling out $1 million and you were losing $390,000 in tax every year, that you could actually pull out the same $1 million, have a similar cash flow, and also grow an investment bucket at the same time. So right now, what we're looking at is ultimately the pass-through structure, which is called a permanent insurance policy. And the type of insurance policy we'll talk about in the next video. And we'll actually look at an example of how this type of policy will grow and how we can help you so that you design the policy that's going to help you achieve this leverageability and optionality to either invest inside of your corporation while having this exit plan at the end, or to leverage at a personal level and still be able to grow your net worth at the same time. All right, my friends, thanks for sticking with me, and we will see you in the next video.